Okay, we want to go through the Chapter 21 Closing the Transaction math worksheet. Make sure you're all good with those items. So we'll get started. Number one, what are the taxes owed by the buyer for the remainder of the year after a March 5th closing if the annual property taxes are estimated to be $4,800? So whenever we are prorating property taxes, we want to write down two very basic statements. The seller owes, and we want to put the period of time that the seller owes for. And the seller always owes from January 1 through the closing date, which is March 5th. And then we want to write buyer owes. And it's going to be March 6th, it can't be the 5th because the seller's already paid for the 5th, through December 30th. Now we want to figure out what each person's share of the year is. And it's always easiest to just start with the seller. So we start with the sellers. From January 1 through March 5th, that's 30 days in January, 30 days in February, and 5 days in March. It's a total of 65 days for the seller. So we've got annual taxes of $4,800 a year divided by 360 days, because we want to break that down to daily, and that's 4,800 divided by 360, and that equals $13.33 per day times 65 days, and that is $866 and about 67 cents. So that's the seller share, $866.67. Well, if you want to talk about the buyer's share, then that's just going to be the difference. It's going to be the $4,800 total minus $866.67, and that leaves $3,933.33 for the buyer. So the buyer's share is $39.33. And the question is, what are the taxes owed by the buyer for the remainder of the year after a March 5th closing? So our answer is right there. That's the taxes that the buyer owes for the remainder of the year, $3,933.33. Alright, number two. If a seller is closing the sale of their personal residence on April 20th, how much will they need to pay in property taxes for the portion of the year they've occupied the property? So again, it's the same exact type of question. Give myself plenty of room here. Same exact type of question. We've got to write down seller owes January 1 through April 20th, because that's their day of closing, and of course that means the buyer owes from April 21 through December 30th. So for the seller's portion, and again, it doesn't matter who they're asking me for, I'm always going to do the seller's portion because it's the easier one to figure. It's 30 days in January, 30 days in February, 30 days in March, and 20 days in April. That's 110 days. 110 days for the seller. So, since they didn't give us any number, so how much do they owe? They owe for 110 days worth of taxes. Okay. Number three. Calculate the proper proration for property taxes for a closing that takes place on June 22nd if the annual property taxes of $1,896 have not been paid and will be paid later in the year by the buyer. So we're going to write our same statements again. Seller owes, and they owe from January 1 through June 22nd. And then, of course, the buyer owes, and they owe from June 23rd, because they pick up where the seller leaves off, through December 30th. Alright, so we want to look at the seller side first. We know the seller owes for all of January, that's 30 days, all of February, that's 30 days, all of March, that's 30 days, all of April, all of May, and 22 days in June. So just check to make sure you're correct. January, February, March, April, May, and June 22nd. So if we do that, I believe that's 172 days. 172 days that the seller owes for. We've got property taxes of $18.96. So we want to break those down to daily. The annual property taxes of $18.96 divided by 360 to break it down into a daily expense. And that equals $5 and about 27 cents a day. It's actually 5.26666 times 172 days. Oops. Sorry, I'm in the wrong place there. Times 172 days. And that gives us a seller total of $905 and 87 cents. So $905, 87 goes to the seller. The buyer is going to be the difference, so that's $18.96 minus $905, 87, because the buyer is going to owe the balance. And so that means the buyer owes $990 and about 13 cents. And that makes sense if you look at it, because it's almost exactly halfway through the year, so they should owe relatively the same amount of money. That's another way you can sort of mentally check yourself. You know, how far are you through the year as far as how much each person owes. So go back to the question, calculate the proper proration for property taxes for a closing that takes place on June 22nd. If the annual property taxes of $18.96 have not been paid and will be paid later in the year by the buyer. So will be paid later in the year by the buyer. We want to do the opposite of whatever they tell us happens not at closing. So whether it's the buyer paying it later in the year or the seller's already paid it, whatever they tell us happened, we want to do the opposite. So what that means is we're going to circle the seller's piece. Since they said the buyer pays later in the year, we want to charge the seller now. We want to do the seller side. You just do the opposite. Focus on that word buyer and do the opposite. Okay? So the correct entry as far as the proration is going to be $905.87 debit or charge the seller, and $905.87 credit to the buyer. That is your correct proration. $905.87 debit seller, $905.87 credit buyer. Okay. Number 4, what's the proper proration entry on the closing statement for property taxes as of the September 12th closing? When on a property where the annual tax bill of $65.48 has not yet been paid and will be paid outside of closing by the buyer. So again, we're going to write down our same two statements. Seller owes from January 1 through the September 12th closing. The buyer owes from September 13th through December 30th, end of the year. Alright, so we're going to prorate this annual tax bill out. Let's see how many days the seller owes. Well, they owe for all of January, all of February, all of March, all of April, all of May, all of June, all of July, all of August, and 12 days in September. 1, 2, 3, 4, 5, 6, 7, 8 times 3 is 240, plus 12 days is 252 days. So the seller owes for 252 days. We know that the annual tax bill is $6,548 a year. Divide that by 360 to get our daily rate. And we come up with $18.19 a day. Times 252 days. And that's going to be $4,583.60. Of course, that's the seller's share. $45.83.60. So that means we can always do the buyer's share by just subtracting. So that's a total of $65.48 minus the seller's share of $45.83.60. And that equals $1,964.40 for the buyer to pay. $1,964.40 for the buyer to pay. Now we need to know which one of those we need. And so find what they tell us. What happens? It says, has not yet been paid and will be paid outside of closing by the buyer. Well, if it's paid outside of closing by the buyer, then we want the seller side here. So the proper entry on the closing statement is going to be $4,583.60 debit seller and $4,583.60 credit buyer. And that's your correct proration entry. Okay. Number 5, calculate the proper proration for property taxes for a closing that takes place on November 9 if the annual property taxes of $29.84 have already been paid by the seller. So again, same thing, write out our two statements. Seller owes from January 1 through November 9. Buyer owes from November 10th through December 30th. Okay, so let's figure the seller side here. Seller owes for all of January, February, March, April, May, June, July, August, September, make some room, October, and then 9 days in November. And so that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months times 30 days is 300 plus 9. That's 309 days that the seller owes for. 309 days. Here's what we know about those taxes. Annually, they're $29.84. So we want to divide that by 360 to break it down to daily. $29.84 divided by 360. And that gives us daily property taxes of $8 and about 29 cents a day times 309 days, almost the whole year, times 309, and that gives us total seller property taxes of $2,561.27. Again, if you're a few cents off, it's okay because rounding would make a difference here. $2,561.27, and that's the seller's portion, so put that with the seller. $2,561.27, and same thing applies. We can do the buyer side by taking the total, which is $29.84, and subtracting what the seller pays, which is $25.61.27. And that leaves a buyer total of $422.73. $422.73 for the buyer to pay. Now we need to know which one of those numbers is our answer. So go back to the question. The annual property taxes have already been paid by the seller. So we want to do whatever is opposite. So they've already been paid by the seller. We pay by the buyer. The buyer owes. We just choose the opposite person. So the correct proration entry on our closing statement is going to be $422.73 debit buyer, right? Got buyer owes, right? Buyer owes. That's debit buyer, and $422.73 credit seller. And that's your correct proration there. Alright, number 6. What would be the proper entry on the closing statement for property taxes prorated between the buyer and seller for a December 12th closing, in which the annual property tax bill of $4,387 has already been paid by the seller? Same process we've been doing all along. Seller owes January 1 through December 12th. Buyer owes for December 13th through December 30th. And we want to figure out that seller side of things. We got January, February, March, April, May, June, July, August, September, October, November, and 12 days of December. So that should be 11 months. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. That's 330 days plus 12 days is 342 days total for the seller. We know that the annual property taxes are $4,387 per year. We're going to divide that by 360 to get to our daily rate. So $43.87 divided by 360. And that equals $12 and about 19 cents a day. Times 342 days, almost the whole year. And that's a seller's portion of $4,167.65. And of course the buyer's portion is always going to be the total, $43.87, minus the seller's portion, $41.67.65. So there's not going to be a lot left over for the buyer to pay in this case, because obviously the sellers own the property for the vast majority of the year. And that looks like a buyer portion to me of $219 $219.35. So $219.35 on the buyer side. So now go back to our statement here. It says the tax bill has already been paid by the seller. So do the opposite. Circle the buyer statement. Buyer owes, well, buyer owes is going to be $219.35 debit buyer and $219.35 credit seller. There's your answer on that one. $219.35 debit buyer, $219.35 credit seller. Okay. Number 7, what entry would show up on a May 10 closing statement for prorated homeowners association dues, which amount to $1,200 annually, but are paid monthly in advance by the seller? So, here's the thing. They're $1,200 annually, but they're paid monthly. So realistically, what we need to do first is break that down into a monthly expense. $1,200 divided by 12 months a year equals $100 monthly. So the seller has paid $100 in advance of closing for the whole month of May, because we're closing May 10th. So we can still do our two little statements. We can write seller owes, and in this case the seller doesn't owe from January 1 through, they owe just starting in May, because this is monthly, not annually. So they owe from May 1 through May 10, and the buyer owes HOA dues from May 11 through May 30th. Okay? The seller owes from May 1st through May 10th. The buyer owes from May 11th through May 30th. And we can do the exact same thing here. So the seller owes for 10 days. May 1st through the 10th is 10 days for the seller. Well, we can take that $100 a month and divide it by 30, or we could take $1,200 annually and divide by 360. It's going to be the same thing, and that's $3.33 a day. Times 10 days that the seller owes for is $33.33. So the seller's portion is $33.33. And just like before, we can do the difference to get the buyer's portion. Well, if it's $100 a month and the seller's paying $33.33, that means the buyer must owe $66.67. So we'll put that up here with the buyer, $66.67. So now go back to the question to see which one is correct. We go back to the question up there, and it says paid in advance by the seller. So if it's paid in advance by the seller, we want to do the opposite one here. We want to choose the buyer. So our correct proration entry is going to be $66.67 debit buyer, because it says buyer owes, and $66.67 credit seller. Okay? $66.67 debit buyer, $66.67 credit seller. Notice it's still the same amount of money on both sides. Alright? Number 8, calculate the correct closing statement entry for rent on a residential triplex that's being sold with a March 4th closing date and rent having been collected in advance by the seller if each unit rents for $750. Well, let's go ahead and take care of one obvious thing and get it out of the way. If the thing is a triplex, it has 3 units. And if they each rent for $750, that means the monthly rent, I believe that's $22.50, but we'll check it. Yeah, $2,250 per month in rent that's been collected. So we're going to write down our 2 statements, but this time we're not going to write seller owes and buyer owes because it's rent. They are owed. So seller is owed rent from from March, because it's monthly, March 1 through March 4th, and the buyer is owed rent from March 5th through March 30th. And here's the reason why we're working with the month of March. The seller got all the rent in February and they were owed all the rent in February. The buyer is going to get all the rent in April because they're going to own the property then. So March is the only month we need to prorate or split up. Alright, so let's look at the seller's portion again. The seller is owed for 4 days. 4 days from March 1 through March 4. We know that the rent is $22.50 per month. So we can divide that by 30 to get to a daily rate. And that's $75 a day. Times 4 days, that's $100 in rent that the seller's owed. So the seller's portion of the rent is $100. Well, just like always, we can take the total, which is $22.50, and we could subtract out the seller's portion to get the buyer's portion. So the buyer's owed $21.50 in rent. We're going to do the exact same thing we've always done before. We're going to go back to the question. We're going to see who it talks about. It says rent has been collected in advance by the seller. So if it's collected in advance by the seller, then we want the buyer's portion here. So our correct prorated entry on the closing statement is going to be, erase that, is going to be $2,150. And the question is it a debit or a credit? Read the statement here. Buyer is owed. The buyer is owed money. So that's going to be credit to the buyer. Credit, oops, sorry, I'm going to use green there. Credit to the buyer. And $21.50 debit the seller. And that's your correct proration for rent. And if you think about it, that makes sense because the seller got all the rent in advance, so we need to take some back from them and we need to give that rent over to the buyer. Okay, number 9. What's the correct proration for rent on a property leased for $1,200 monthly that's closing on February 12th? We're going to do the same thing we just did above. We're going to write seller is owed rent from February 1 through February 12th. The buyer is owed rent from February 13th through February 30th. Right, well that's 12 days for the seller. February 1 through February 12th is 12 days. We always do the seller side. The rent is $1,200 per month. So we can divide that by 30 days to get it down to daily. $40 a day times 12 days is going to be $480. And that's the seller side, $480. Well, same thing we've done over and over and over. The total of $1,200 minus the seller side of $480 will give us the buyer side. And that's $720 for the buyer side. So let's go back and look at what's happened up here. It says, what's the correct proration for rent on a property leased for $1,200 monthly that's closing on February 12th? Well, here they didn't give us the statement. And here's why. We know what's happened with the rent. Rent is always paid on the 1st to the seller. And if it was paid to the seller, then we want to do the opposite here. So we want the buyer side. So the correct proration is going to be $720 credit buyer, $720 debit seller. All right. Number 10, calculate interim interest. This is a quick and easy one, as long as you know what interim interest is. Remember, interim interest is future interest. This word interim right here means future. Not past, but future. And it also means, when we're talking about the future, we're talking about the buyer. Buyers pay interim interest, sellers pay accrued interest. Alright? So, in this case, we want future interest from the closing date. So from April 12th through April 30th. Now this is where it's harder to count the days. This is not 18 days, this is 19 days. And I don't care if you have to use your fingers, I don't care if you have to use your toes, I don't care if you want to use tick marks. I mean, you can do it like that. You can say April 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30. That's 5, 10, 15, 19 days. You got to start paying that interim interest on the day of closing. So, as far as our interest math goes, we have a $225,000 mortgage loan at 5% annual interest. So that's interest for the whole year. So 225 times 5% is $11,250 per year in interest. And we need to break that down to daily so we can do 19 days. So divided by 360. Whenever you got yearly and you want to go to daily, you divide by 360. And that equals $31.25 per day. So $31.25 per day and times 19 days. So here we go, $31.25 a day times 19 days. That is $593.75. And interim interest is always a debit, and it's paid by the buyer. So that's $593.75, and it would show up as a buyer debit on the closing statement. Number 11 deals with interest in the past. It says, what is the accrued interest? So some room here. What is the accrued interest on a $156,000 loan as of the November 10th closing? Well, this word accrued means past, and that equals seller. So it's the seller paying this. And then interest has been accruing since the beginning of the month, so November 1 through November 10th. And that is 10 days. Right, so we need 10 days of accrued interest. Well, our loan balance is $156,000. Okay, and it's interesting that I gave you this question, I didn't give you an interest rate, so I guess you could have picked one. I'm just going to say, for purposes of this question, we'll say 4% here, 4% interest. Okay, so times 4%, I apologize for that. So times 4% annual interest, and I had to make that up because I didn't give it to you in the question, and I should have. $156,000 times 4%, that equals $6,240 in annual interest, and we're going to divide that by 360 to get it down to daily. And that is $17.33 a day times 10 days, and that is $173.33 in accrued interest. $173.33, and of course that's going to be debit seller because it's accrued interest. Okay. Number 12, what's the correct payoff amount for a seller's loan with a July 12th closing date if the note is issued with a 5.25% annual interest rate and had a balance of $248,500 as of the last monthly payment? So, loan balance payoff, and we've done these before, is going to be the loan amount of $248,500 plus the accrued interest. So we need to know how much accrued interest. Well, it's July 12th, so there's 12 days of interest that's built up. So $248,500 times 5.25% annual interest. That's $13,046.25 per year. And we're going to break that down into daily by dividing by 360 equals $36.24 per day. Okay, so we've got $36.24 per day times 12 days. That's $434.88 in accrued interest. That's our accrued interest. So we're going to add that back. So $248,500 plus $434.88, which is our accrued interest, means our loan payoff is $248,934.88. That's our payoff amount as of that closing date. Number 13, what's the excise taxes due on a $428,200 sale where the buyer obtains an 80% loan-to-value loan and the seller takes back a note for $15,000? Well, let's talk about a lot of this information that's in here. First of all, this seller takes back a note. That's seller financing. And what does that mean for this question? Absolutely nothing. I only want to point it out because I don't want you to be unfamiliar with the terminology. But we don't care about seller finance when we're talking about excise taxes. We also don't care about buyer obtaining a loan. We're talking about excise taxes. The only thing that matters with excise taxes is the sales price. And with the sales price of $428,200, we can't calculate excise taxes because we need this digit. Oh, sorry. That eraser here. Well, we need this digit right here to either be a 5 or a 0. And we always round up. So this is not going to be 428,200. This is going to be 428,500 because it's always got to be in multiples of 500. And then we're going to divide that by 500 because that's the rate for excise taxes. 428,500 divided by 500 equals $857, and that's a debit to the seller. $857 debited to the seller. Seller pays excise taxes. Alright? Number 14 says a closing statement includes a charge to the buyer for 4 months worth of property taxes to be escrowed such that taxes can be paid later in the year by the lender from the escrow account. If the home has an assessed tax value of $385,000 and ad valorem tax rates in the area are $1.18 per 100, what will be the correct amount of the escrowed property taxes on the closing statement? So they want us to calculate 4 months worth of property taxes. Well, before I can get to 4 months, I need to get to a whole year. So we're going to be looking at the T-bar for property taxes. And from way back in Chapter 3, the annual property taxes are on top. And down here on the bottom, we have the assessed value and the property tax rate. So to calculate the annual property taxes, we've got an assessed value of $385,000, that goes right here, and we've got a tax rate of $1.18, that goes right there. So our math to get our annual property taxes is $385,000 times 1.18%. Alright, and that is $4,543 per year in property taxes. And they want 4 months worth of that, so we're going to take the annual 43, we're going to divide that by 12 to get to monthly. And that is $378.58 times 4 months. And that is $1,514.33. And because it's the buyer's property tax escrows, that's going to be debit the buyer. Remember, on a closing statement type question, you always need to know who you're debiting or who you're crediting. In this case, it's going to be debit the buyer. Number 15 says a closing that takes place on March 15th calls for the closing attorney to place 5 months of real property taxes and 2 months of homeowner's insurance into escrow. If the annual property taxes are $3,000 and the annual homeowner's insurance is $480, what's the total amount that will be placed into the buyer's escrow account, and how will it be recorded on the closing statement. Okay, so we got two pieces here. We've got 5 months worth of property taxes, and we know annual property taxes are $3,000. And then we've got 2 months of homeowners insurance, and we know that the annual homeowners insurance is $480. So I used the two different colors there just to group them together, but you need to make sure to get these grouped together somehow mentally for yourself. So let's work on the property taxes first. Property taxes are $3,000 per year. If we divide that by 12, we can get it down to monthly. And that's $250 a month. Times, and they want 5 months worth of them. So that's going to be $1,250, $1,250 in tax escrows. Alright, we also know that we've got homeowners insurance, which is $480 a year, which we can divide by 12, which gives us $40 a month, I believe. Let me check my math, make sure. Yeah, $40 a month times 2 months. So that's $80 in insurance escrows. And the question is, what's the total amount that will be placed in the buyer's escrow account, and how will it be recorded? Alright, well the total amount is going to be these two added together. So this and this added together is the total amount. So $1,250 plus 80 equals $1,330. Sorry, $1,330, $1,330 total. And because this is all the buyer's escrows, it's going to be debit buyer. $1,330 debit buyer. Okay. Number 16 is pretty much a full-on closing statement. So I'm going to kind of zoom this down so we can see it all at one time. And then I'm going to go and make myself plenty of room here so that I can work. Alright, so the first thing I'm going to do is make myself like a little list of bullet points. And I see that it's a full, when you see something this long, just kind of scan through and then find the question. Well, the question's all the way here at the end. How much cash, rounded to the nearest $100, will the buyer need to bring to closing? Okay? How much cash does the buyer need to bring to closing? Well, this is a closing statement question. So here's what you know you're going to need to set up. You know you're going to need to set up a worksheet where you've got seller credits, seller debits, buyer credits, and buyer debits. Four columns. Okay? And I'll continue the lines down as I need them further. We know we need 4 columns because we're doing a closing statement. The other thing we really need to do to help ourselves out is to get this into some bullet points so that we can understand it rather than trying to deal with it in this paragraph format. So here's what I'm going to start doing. I'm going to start listing everything and then kind of crossing off and dealing with it one at a time. Terrace closing on February 28th. So I'm just going to put closing February 28th. Okay? So we've got that. New home in Clayton for a purchase price of $278,500. So $278,500 purchase price. Okay? So we're done with that. She's obtaining a new 30-year fixed-rate mortgage loan with a 4.75% annual interest rate, 80% loan-to-value. So I'm going to make another bullet point for myself. I'm going to go 80% loan-to-value, 30-year, and it's at 4.75% interest. Okay? And we'll pay the remaining balance in cash at closing. That means absolutely nothing for you. That's the whole point of what we're doing, is trying to calculate how much cash the buyer needs to bring at closing. You don't need to do anything with that statement. That will take care of itself. That's what this is. This is an accounting statement to see how much money that buyer needs to bring in cash at closing. When she went under contract using the standard offer to purchase and contract from NC Realtors, she paid a $500 due diligence fee. Well, there's our next bullet point. $500 DD fee. Okay. To the seller, which we know, and placed the $1,500 earnest money deposit into escrow at the listing firm. So there's our next bullet point. We got a $1,500 EMD, earnest money deposit. Okay? Alright, so we can mark that out. At closing, she will need to pay interim interest on her new mortgage loan. Alright, so there's a bullet point. Interim interest. Alright, what's our next bullet point? Cross this out. As well as a 1% loan origination fee. Okay, 1% origination fee. Alright, there's that. And 2 discount points on the note. Okay, so 2 discount points. Again, we're just doing this to make sure we don't miss anything. She will pay her first year of homeowner's hazard insurance in the amount of $720 at closing. So that's a bullet point. She's going to pay at closing, which is what we're doing, $720 in homeowner's insurance. Okay, mark that out. Additionally, she will need to escrow 4 months of property taxes based on an annual tax bill of $3,600. Okay, so I'm going to write that as 4 months tax escrow. And I'm also going to do a separate one that says $3,600 annual taxes. We don't know who they're paid by yet or what's happened to them, so I'm going to leave a little blank there. We'll figure that out in a second. But we know that the taxes are $3,600 per year. And 2 months of hazard insurance. I don't care that we've already done a year of hazard insurance. They say 2 months more, so we do 2 months more. So we're going to put another bullet point here. 2 months of homeowner's insurance or hazard insurance, same thing. Okay? The property taxes have not yet been paid and will be paid later in the year by the buyer. Again, I'm just going to take that information down and I'm going to add it to my property tax line down here. If I can get the computer to scroll. Okay. So the property taxes not, let me taxes not paid later by buyer. And I know that goes with this line right here. Okay, the $3,600 annual taxes are not paid, have been paid later by the buyer. That's all basically one point together. Okay? Alright, so we can mark that out. Get rid of this crazy line that it just put in there. Okay. Based on the above information, how much cash, rounded to the nearest $100, will the buyer need to bring to closing? Well, we have put everything into a very compacted list that we can now deal with so that we can calculate everything we need to know. Alright? So, one of the things you can do is you can go through and do these one by one and put them in place as you go through them. Don't skip any, just go through them one by one. Well, the closing date of February 28th, there's nowhere for us to put that in the actual closing statement. We will need it when we're doing our prorations, but there's nothing for us to actually enter for that, so we just check it off. The purchase price of $278,500. That definitely needs to go in. And that's going to go in as a debit to the buyer and a credit to the seller. So I'm going to go debit to the buyer for $278,500. Buyer debit. $278,500. And seller credit for $278,500. Credit the seller, debit the buyer for the purchase price, and then check it off. We're done with that. Alright, the next one, 80% loan to value, 30-year loan at 4.75% interest. So I need to calculate the loan amount. Well, 80% loan to value is going to be $278,500 times 80%. 278, actually, why don't I do this? Let me go to I made a blank sheet for all my work. Let me just slide over there, that way I've got everything together. Okay? Try to keep it neat so you can see what I'm doing here. Alright, so we've got a loan amount. There we go. Now we can. So we got a loan amount, which is going to be 80% loan to value. So $278,500 times 80%. This is going to be our loan. And that's a loan of $222,800. $222,800. So what I'm going to do is I'm going to go back and put this in a couple of different places. Okay? I'm going to go back and put that loan here. $222,800. I'm going to check it off because I'm going to scroll down and put it in my closing statement. $222,800. And that goes in the buyer credit. So if you keep everything listed, you'll know what they are, so you can check yourself if you need to. So there's our loan amount. Remember, the loan is a credit to the buyer. Alright, let's go back up here to our list. Alright, we've got a $500 due diligence fee. Okay, so a $500 due diligence fee, we don't need to do any math with it. We're just going to take it straight to our sheet here, and that's credited directly to the buyer. $500 due diligence fee. Well, the seller, we also need to take that due diligence fee away from the seller because they got it in advance. So the due diligence fee is going to be credited to the buyer and debited from the seller. So that goes in there twice, all right? So we can check off the due diligence fee. Now we've got the $1,500 earnest money deposit. Well, with a $1,500 earnest money deposit, again, we don't need to do any math whatsoever. We just need to scroll down and put it in our worksheet here. And a $1,500 earnest money deposit is going to be credited to the buyer. That's a credit for the buyer. It doesn't do anything at all on the seller side because the seller didn't get that money in advance. So that's all we need to do with the earnest money deposit. Now, interim interest. Interim interest, remember, is interest on the new loan. So make sure you go to the loan amount of $222,800. And we know that that loan's at 4.75% interest. And the other thing we know about that loan is that it's closing on February 28th. Those are all the pieces we need to do interim interest. So when we talk about interim interest, then we're looking at, scroll down here, oops, back, forgot my interest rate, 4.75%. Alright, so 4.75%. So we've got our loan here of $228,800 times 4.75%, and that's an annual interest rate. I'm sorry, $222,800. 222, can't read my own handwriting apparently. $222,800, and that's going to be times 4.75%. That's $10,583 per year in interest, and we want to divide that by 360 because we want to break it down into daily. So divided by 360, and that equals $29.39 or 40 cents. 29.40, I guess, if I round, per day. And we're closing on February 28th. So that's February, counting them, 28, 29, 30. That's 3 days. So times 3 days. That is $88.20 in interim interest. $88.20 in interim interest. So I'm going to scroll back up here, and I'm going to list $88.20, and that's going to be a buyer debit. So I'm going to check that off because I'm going to go right back down here now and put it in buyer debits. $88.20 interim interest. Alright, next bullet point, 1% origination fee. Well, it's 1% of the loan amount, so if we want to do an origination fee, we come right back to that loan amount of $222,800 times 1%. That is $2,228 in origination charges. So $22.28 for our origination. So I'm going to put that in here on this sheet. $22.28. Oops. And I'm going to check that off because I'm going to put that in my worksheet. That is a buyer debit. $22.28 is a buyer debit for the origination. We go back up 2 discount points, okay? So 2 discount points is going to cost 2% of the loan amount. So we take the loan amount of, my computer's getting jumped up, $222,800 times 2%, because we have 2 discount points. That $4,456 in discount points. So $44.56 in discount. Scroll back up here. Alright, that's $44.56. Okay, and we're going to check that off because we're going to put it in our sheet. We know that is a buyer debit. That's also a buyer debit. So we're going to scroll down here and go $44.56 in the buyer debit column for the discount points. So again, none of this math is hard. It's just a matter of going through it one slow step at a time. $720 in homeowners insurance is our next bullet point. There's no math to do there. They just want us to charge the $720 in homeowners insurance. That's going to be charged to the buyer. So we're going to scroll down to the buyer and put $720 in buyer debit for the homeowners insurance. Taking care of that. 4 months of tax escrows, and we've got on the next line that the annual taxes are $3,600. Okay, so I'm just going to do that work right here in the margins. $3,600 divided by 12 equals $300 a month. Yep. Times 4 months is going to be $1,200. So this is $1,200 for tax escrows. And that's going to be the buyer's tax escrow. So we're going to scroll right down and put $1,200 in buyer debit. I'm going to extend these lines down just a little bit. $1,200 in the buyer debit column. Okay, so that takes care of that bullet point. The $3,600 annual taxes, that's really just for reference purposes, so we'll hold on to that one. 2 months of hazard insurance. Okay, so 2 months of hazard insurance, that ties back with $720 a year for hazard insurance. So our math over here on that one is going to be 720 divided by 12, and that equals $60 a month. And they want 2 months times 2, and so that's going to be $80 in insurance escrows. And we're going to check that off because we're going to scroll right down right away and put that in buyer debit, $80. Right? And then this last one says the taxes are not paid will be paid later in the year by the buyer. And we know that that ties together with this one, the $3,600 annual taxes. Taxes have not been paid, will be paid later by the buyer. So, let's go down, and we know we're closing again. Our closing date matters on taxes on February 28th. So let's go down and write our 2 statements out for taxes. The seller owes from January 1, they owe taxes from January 1 through February 28th. The buyer owes taxes from February 29th through December 30th. I know that looks weird, but remember every month has 30 days. So the seller owes January 1 through February 28th, and the buyer owes from February 29th through December 30th for taxes. Okay? We always want to do the seller side first. We want to look at the seller side. The seller owes for 30 days in January plus 28 days in February. That's a total of 58 days. 58 days of seller taxes. Well, the annual taxes are $3,600. Divided by 360 is a very even $10 per day. Times 58 days is $580 for the seller. So the seller owes $580. And remember, we can always take the total of $3,600 and subtract the seller side to get the buyer side, because they're splitting this expense. So $3,600 minus $580 gives us $3,020. $3,020 to the buyer side. And what they told us about the taxes is that the taxes had not been paid and would be paid later in the year by the buyer. So since they mentioned the buyer, we circle the seller. They've not been paid, would be paid later in the year by the buyer, so we circle the seller. Which means our entry is going to be $580, and we want to debit the seller and $580 credit the buyer. $580 debit seller and $580 credit buyer. So we're going to scroll back up and put this one last thing into our little spreadsheet up here that we've made. Okay, $580, and that's a seller debit, taxes, and $580 is a buyer credit. Alright, so now we can total each one of these columns up. Well, seller credits is $278,500. Seller debits is $1,080. So now we can take the difference between these two, and that's how much money the seller is going to get at closing. So at closing on this transaction, the seller's going to get $277,420. That's the seller side. Okay? So now let's total the buyer's columns. Alright, we total the buyer's credits. $222,800 plus $500 plus $1,500 plus $580. That's $225,380. And then we want to total the buyer debits. That's $278,500 plus $88.20 plus $2,228 plus $4,456 plus $720 plus $1,200 plus $80, and that is $287,272.20. Alright, and I'm going to check that number again. One of the things I always do when I'm totaling that many numbers is just run them again, make sure I've got the right number there, because it's very easy to make a mistake when you're keying in that many numbers. So Give me just a second. I'm checking that math. And I came up with 287, 272, and 20 cents again. So now we can take the difference between these two numbers to get the buyer's cash at closing. And the difference between those two numbers is $61,892 and 20 cents. That's the buyer's cash at closing. So the buyer owes $61,892 and 20 cents, and the seller is owed $277,420. And so if we go back up to our question, I believe they want to know rounded to the nearest $100. They want the buyer side, and they want it rounded to the nearest $100. So buyer side is going to be $61,900. That's rounded to the nearest 100 is $61,900 is your total answer there. Okay? And then the last one is the exact same thing over again, so I'm going to do the same thing. I'm just going to take a second and set up my workspace here. If my computer will cooperate. Alright. Okay. So let's go ahead and draw our, or write out my columns. Seller credit, and again, it doesn't matter what order you put them in, as long as you got credits and debits for both sides. So seller credit, seller debit, buyer credit, buyer debit. Alright, and now we're ready to roll. Okay, so we're going to go up and we're going to do the same thing. We kind of put this in bullet point format. It says Sam is purchasing a home for $310,000, which will close on April 19th. He's obtaining a 90% loan value loan. Well, let's go ahead and start doing bullet points here. Okay, so, alright, bullet points. First thing I see is that I need to erase this junk. Okay. First thing I see is Sam is purchasing a home for $310,000. That purchase price needs to be our first bullet point. $310,000 purchase price. If you wanted to, you could go ahead and note it for yourself. Okay, that's going to be debit, buyer, and credit, seller. Make a note for myself. Okay, and we can cross that out. It will close on April 19th. Alright, closing April 19th. Alright, he's obtaining a 90% loan to value loan. Okay, so 90% loan to value. Okay, bullet point. And paying the remaining balance in cash at closing. Again, that statement means nothing. That's what we're doing the math for. When he applied for his mortgage loan, he paid a $50 application fee, and when he was approved, he paid $450 for a home appraisal. This is the tricky part about this question. Notice it says when he applied for his mortgage loan, he paid, and when he was approved, he paid. Folks, we don't care what he already paid for. Our job is to figure out what he is paying for right now. So things he's already paid for, we're going to ignore. We do not care about things like application fees that the buyer's already paid for. So that just gets discarded. Those things go away. At closing, he will incur expenses including a 1% loan origination fee. So we got 1% origination. Alright, let's scroll up some here so we can, oh come on. Pay the origination fee. Now let's see if we can scroll it. He's got 2 discount points, so there's our next bullet point. 2 discount points. Okay, cross that out. And interim interest on his new mortgage loan. So we're going to put interim interest. And they told us that the loan is at 4.5% interest. Okay? So, and interim interest on his new mortgage loan being issued at 4.5% annual interest. Took care of all of that. Alright? It says when he went under contract on the property, he paid a $1,000 due diligence fee. Okay, well the due diligence fee we do care about, so we've got a $1,000 DD fee. And he paid a $2,500 earnest money deposit. Okay, so we've taken care of that. It says the seller's paying a 7% brokerage commission as well as excise taxes at the standard rate. Okay, so we'll make a couple bullet points for the seller. Seller's paying 7% commission. The seller's paying excise taxes. Okay, so cross all that out. It says the seller also must pay off their $170,000 mortgage balance. Okay, so the seller's got to pay $170,000 mortgage balance. So we need to scroll down here, get some room. So seller pay off $170,000 mortgage. Okay, back up, cross that out. It says, and the seller will have to pay $150 to pay to have the deed prepared for closing. So again, we're going to make a little note for ourselves, a bullet point. Seller pay $150 for deed. Okay. It says property taxes are $3,150 for the year and have not yet been paid. So property taxes are $3,150, have not yet been paid. The buyer will pay the property taxes later in the year. So we can mark all that out and make one bullet point for it. Alright? Property taxes. My computer definitely needs to be restarted. It is not happy right now. Alright. So taxes are $3,150 for the year. Not paid. Paid later by the buyer. Okay? The buyer is going to pay their annual homeowner's insurance policy of $720 at closing. Okay? So the buyer's paying $720 annual insurance premium. Buyer. And then we've got, running out of room is what we've got. Hang on. My computer's thinking. Good thing it's the last question. And the closing attorney has also been instructed to collect 5 months of property taxes and 2 months of hazard insurance for the buyer's escrow accounts. So, 5 months of property taxes and 2 months of insurance. We're just barely going to fit it. 5 months property tax, escrow, 2 months insurance, escrow. Alright, so let's do this one just slightly different than the last one. We're just going to go ahead and label everything, and that's all the information. It says, based on the above information, how much cash will the buyer need to bring to closing round to the nearest $100? Let's just go through on this one, and let's mark each one of these where they're going to go, okay? The closing date doesn't go anywhere. Alright, we've already marked the purchase price. Closing date doesn't go anywhere on the closing statement as far as our columns. The 90% loan to value new loan, that's going to be credit to the buyer. 1% origination fee, that's going to be debit to the buyer. 2 discount points, debit to the buyer. Interim interest, debit to the buyer. Due diligence fee is going to be credit to the buyer, debit to the seller. Earnest money deposit is going to be credited to the buyer. 7% commission is going to be debited from the seller. Seller excise taxes debited from the seller. Sellers pay off the $170,000 mortgage, that's debit to the seller. Seller pay $150 for the deed, that's debit to the seller. Taxes of $31.50 not paid, we'll hold off on that and wait till we write our statements out. $720 annual insurance paid by the buyer, that's debit to the buyer. Erase that crazy line. Come on. Erase. There we go. Debit to the buyer. 5 months of property tax escrows, debit to the buyer. And 2 months of insurance escrows, debit to the buyer. So we've pretty much filled everything in except our property taxes, and we'll do that with our 2 statements. Alright, so let's start working on this thing. $310,000 purchase price. And we already said debit, buyer, credit, seller. So put a check mark beside it, let's fill it in. Debit, buyer, credit, seller for $310,000. Alright, done. 90% loan to value loan. Okay, well, I'll do it right over here in the, actually I'll scroll down to the other page. 90% loan to value loan. Alright. We got a $310,000 purchase price, so the loan is going to be $310,000. Apologize for the computer issue here. I don't know why it's doing that. There we go. $310,000 loan times 90% loan to value. That's $279,000. For the loan amount. Alright, we already wrote down that that's going to be a credit to the buyer, so $279,000 credit to the buyer. Alright, takes care of the loan. Back up here. It will. Okay. So we've taken care of the loan amount. A 1% loan origination fee. Alright. A 1% loan origination fee and then 2 discount points. I think we can handle those both at the same time. Well, 1% loan origination fee is going to be $279,000 times 1%. Is $2,700. $790 for the origination fee. And discount points is going to be $279,000 times 2%. And that is $5,580. And we know both of those are debits to the buyer. We already wrote that down. So we're going to go put them in here for ourselves. Okay. $27.90 and $55.80. Gosh, this thing is really struggling right now. Alright. $27.90 buyer debit and $55.80 buyer debit. So we've taken care of both of those. Interim interest at 4.5%. Well, interim interest is always from the day of closing until the end of the month. So that's going to be from April 19th through April 30th. April 19th through April 30th. Okay? Alright, so let's scroll down, get our workspace here. April 19th through April 30th. So for interim interest, we're going to look at that $279,000 loan at 4.5% interest. I believe it was 4.5%. I have to scroll back up there, but I'm going to have to. Yeah, 4.5%. Okay, so $279,000 times 4.5% interest. That equals $12,555 per year divided by 360. And that equals $34.88 per day times, we're closing on the 19th, so we've got 12 days. 12 days. So 34 times 12, and that's about $418.50 for interim interest. $418.50. So if we go back up and take a peek of where that needs to be, $418.50 we said was a debit to the buyer. So here we go, $418.50 debit to the buyer. Okay. $1,000 due diligence fee, credit to the buyer. And debit from the seller. Alright. The earnest money deposit was $2,500. That's going to be credited to the buyer. Takes care of that. Check those off. We're done with them. 7% commission to the seller. That's 7% of the total purchase price. Okay? So 7% of the total purchase price. Total purchase price is $310,000. So $310,000 times 7% is $21,700 seller debit for the commission. It's a big one, big charge. Okay, seller pays excise taxes. Well, we know the excise taxes are the sales price divided by 500. So the excise taxes are going to be, I don't know why that's there. Get rid of that. The excise taxes are going to be sales price of $310 divided by 500. So we'll go down here. We can do it right here. Sales price of $310,000 divided by 500. That equals excise taxes of $620. Excise taxes of $620, and that's also going to be a seller debit. Okay, go back up to our bullet points. Almost getting down to the nitty-gritty here now. Okay, we can check off excise taxes. The seller's going to pay off their $170,000 mortgage. There's no math involved there. That's just a seller debit. So the seller's going to pay off their oh wow, but my excise taxes just moved all around. It's $620. Right? So, $170,000 mortgage that the seller's going to pay off. And it said the seller was also going to pay a deed prep fee. Seller was also going to pay a deed prep fee of $150, so we want to check off both of those. Okay. So I'm going to put the $150 in the seller debit column. Alright, go back up. So the taxes of $31.50 are not paid, going to be paid later in the year by the buyer. Alright? So taxes of $31.50 are not paid, they're going to be paid later in the year by the buyer. We go back to our same statements that we always use, alright? And we know we're closing on April 19th, that's important. We know the annual taxes are $31.50 and they're not paid, that's important, okay? So make sure you got all the April 19th, $31.50, alright? That's what we know. We know we're closing on April 19th. We know they're $31.50 per year. Alright, so let's write our two statements for the taxes. The seller owes taxes from brain's not functioning, January 1 through April 19th. The buyer owes taxes from April 20th through December 30th. And we want to do the seller side first. It's always easier to do the seller side first. So the seller owes taxes for all of January, February, March, and 19 days in April. That's 109 days. 109 days. We know that the taxes are $31.50 a year, so we can divide that by 360 to get it down to daily. $31.50 divided by 360 is $8.75 a day. $8.75 a day times 109 days. That's $953.75 for the seller. Now we know we can always calculate, with any tax issue, we can calculate the buyer side by taking the total, which is $31.50, and subtracting what the seller pays, which is $953.75. If we do that, we come up with a buyer side of $21.96.25. $21.96.25. And here's what they told us about the taxes. They said that the taxes would be paid later in the year by the buyer. So if they said they'd be paid by the buyer, we want to charge the seller. We want to do the opposite. So that's the amount we owe, and it also tells us who to debit and credit. Because seller owes means debit the seller. And if you're debiting the seller, that means we're crediting the buyer. So $953.75 is going to be a seller debit. And a buyer credit. And that takes care of the property taxes. Okay? $720 annual insurance paid by the buyer. That's just debit the buyer with no math to do. So $720 buyer debit. You can check that off. 5 months of property taxes. Well, with the property taxes, we've already worked on them down here. Here's what we know about the property taxes. They're $31.50 a year. They're $31.50 a year. So, if we take that $31.50 a year and divide it by 12, we end up with $262.50. And I believe they want 5 months, so we can multiply that times 5. And that's $13.12.50 for the tax escrows. $13.12.50. Okay, and that's a buyer debit. 13. And 2 months of homeowner's insurance. Well, we know the homeowner's insurance is $720 a year. So $720 a year divided by 12 is $60 a month, times 2 is $120 buyer debit for the property insurance. And finally, that's it. We're done with everything that needs to be filled in on this thing. The only thing left now is to add everything up, to total all these things up. Okay? So, let's do that. Well, easy to total seller credits right here, $310,000. For seller debits, we've got $1,000 plus $21,700 plus $620 plus $170,000 plus $150 plus $953.75. That is $194,423.75. And I'm going to check that number again, because remember, I'm keying a lot of things in here. So 1,700 plus 620 plus $170,000 plus $150 plus $953.75. $194,423.75. Buyer credits, I'm going to total those up. $279,000 plus $1,000 plus $2,500 plus $953 75 equals 283 $453 and 75 cents. And buyer debits, which I'm going to check a couple times just because there's so many numbers. $310,000 plus $27.90 plus $55.80 plus $418.50 plus $720 plus $13.12 and 50 cents plus 120 equals 320 941. I'm going to check that number one more time. $13.12 50 plus 120. $320,941. Alright, came up with the same number. So now we've got everything we need to calculate both sides. Alright, the seller side, the difference between the two. The difference between the two on the seller side, the seller's final number is going to be, drum roll please, $310,000 minus $194,423.75. The seller's cash at closing, so this is the check that the seller could expect to get when they go to closing, or come away from closing rather, would be $115,576.25. And then the buyer's cash at closing, we take the difference between those two, $320,941 minus $283,453 and 75 cents. The buyer's cash at closing is $37,487.25. So you could think of that as the buyer's down payment if you want to, but that's the amount of money that buyer has to bring to that closing. And the question was, what's the buyer's amount of money to the nearest $100? So your answer to that question is going to be $37,500. Obviously, there is a lot of work involved in answering one of these closing statement questions. So you're only going to spend your time doing this if you've completed everything else on the test. But make sure you do understand the math involved with doing these, because the math involved with doing these is going to show up again and again. You may have to do property tax prorations. You may have to do excise taxes. You may have to do interim interest. So make sure you're familiar with the math. Even if you struggle with getting every single piece of this together, make sure you know how to do the individual pieces of math. And hopefully if you do, you'll be able to pull it all together.